Favorite actor, 5 seconds. 5.
Natalie
4.
Portman.
Nice.
Wow.
Favorite movie, 5.
Dumb and Dumber.
Hold on a second. Time out.
Do y'all love me?
Outstanding.
Stop recording.
That is outstanding.
Welcome to the Futures Edge podcast. I'm Jim Urio, and as always, co-host, brains of the operation, executive producer Bob Iacchino, and I'm coming to you from lovely Mississippi River, New Orleans, where I was just speaking at the New Orleans Investment Conference this morning, which was a ton of fun. New Orleans is kind of like Nashville's seedy black sheep, darker brother, it seems like to me. But anyway, on the podcast today, we have Nancy Davis, the managing partner, CIO, Quadratic Management, former Goldman Sachs. Thank you for coming on, Nancy. Appreciate having you.
Thanks for having me.
Okay, so one thing I talked about this morning, and I want you to comment on it, is that the Fed continually talks, and Bobby and I have this argument all the time about when the Fed's going to pivot. The Fed continually talks about needing to see certain things, certain parameters. All of us understand that there's a lag effect of tightening or easing. Does this absolutely guarantee, if they need to see it, if they need to probe the wounds, does this necessarily mean they will overdo it this time?
Well, it's unclear if they've already overdone it.
Yeah. Okay. Great. Exactly. Yeah.
It's like, look, they've been very fixated on prices. That's been the focus, but there are a lot of other global issues, a lot of kind of almost financial crises brewing right now at the UK. Tensions have escalated around the world. The supply chain disruptions are raging still. They're still an issue. And the Fed's been pretty wrong about a lot of the things that they have forecasted and said. So I don't have, personally super high confidence that they're going to be able to get this just right. I think the thing that shocks me is that the inflation markets really believe that they will. The inflation markets are really priced for a dramatic fall in inflation expectations, even with the CPI coming out yesterday at 8.2, just even looking at something as simple as the inflation protected bond markets, the TIPS markets, which are Treasury inflation protected securities. The expectations for CPI, just even 2 years forward or 5 years or 10 years, it's all downward sloping. It's all pretty symmetric around 2%. So it's, I think, a good opportunity for investors to kind of take a step back and say, look, we don't know if the Fed's going to be successful or not, but they have convinced the bond markets that they will be and that they will tame inflation. Even the Fed's 5-year break-even index is currently 2.07, like not even 2.1. So yeah, it's a good opportunity for investors to add some inflation protection to their portfolio. I think the one challenge is that a lot of people look at the 70s, what happened in the 1970s when they're thinking about evaluating inflation strategies. And the problem is like, the inflation protected bond markets didn't exist back then. The US Treasury only created the inflation protected bond market in the late 90s, in 1997. And then the rate derivative markets, really didn't start until, much later than that even. So even though you can get data on swaps going back to the 80s, I think a lot of people just don't look at something, I feel like people are overcomplicating it by looking at commodities and all these other like infrastructure, all these other ways to capture inflation. I think just keep it simple and use inflation rates is my 2 cents.
Okay, so you glossed over something a second ago about the UK and the Bank of England, and potentially 10-year yields have gone from 1.8 to 4.5 in basically a couple months. A staggering move. And all of a sudden they flipped and started buying bonds again. Was that when you saw them flip and start buying bonds again? Do you think that's indicative of just absolutely being terrified that pensions, whatever, someone are leveraged up gilts and are about to go bankrupt?
I mean, at the end of the day, if you take a step back, like what are central banks supposed to do? They're the buyers of last resort. And that's what the UK needed to step in, because we were on the verge of having another, financial crisis moment where, you don't want to have the problem. Derivatives have a really bad reputation for a really good reason. And I'm personally not a fan of linear derivatives, which is what like 99% of the world uses, which is futures, swaps, forwards, all these things go up $1, go down $1, and you don't really buy them, right? You just use, it's kind of like a credit card where you get a lot of exposure to something, but you don't really pay for it. And at any point you can have a margin call, no matter who you are, even if you're a pension fund or a sovereign, when you use leverage, especially linear leverage, and the position goes against you, at any point you could have a call on cash against those contracts. Even if it's an exchange traded product, the exchange could call cash. So that's kind of what happened with the UK. And I think the Bank of England really had to, it was, I'm sure, a lot of egg on their face, right? They're about to embark on quantitative tightening. And then the Financial Stability Group of the central bank had to come to the rescue to basically bail out the financial system. Like that would have been, but it's not a good sign, right? It's just a sign of how many years of low interest rates have caused many institutional investors to take additional leverage in their portfolio, especially in government bonds around the world. And leverage is coming back to bite them now, because when you receive rates, it's basically like levered long government bonds.
Yeah. Okay. So something, I guess what we're both saying is, and now we're going to talk about the Fed pivot. So first of all, just in a word,
Stop
does the
it.
Fed pivot? No, you stop it. Does the Fed
Ugh.
pivot go to neutral? Does the Fed go to neutral in the next 2 months, in the next quarter?
Bobby, is he baiting me?
No.
Okay, so look, here, I just want to throw this out.
I'm
Jim
getting my
knows
water.
it
Hold on.
literally makes my skin crawl when people use the Fed going to neutral and they say pivot. Because we all played sports. A pivot was a complete turnaround and a move in the other direction, in my opinion, or at least a cut, right? Like,
Okay, yeah.
I was a running back. If you freaking cut, I would say, "Oh, I used my pivot foot. I stopped and went the other direction." Whatever. I like pause, not pivot.
Okay, good. Okay, I want to use pause. I really wasn't trying to yank your chain. I probably was trying to yank your chain.
Now I'm gonna have a second drink because you got me all upset.
I'm in a hotel room and I have no beer. Nancy, normally Bobby has a bourbon, I have a beer, but I have no beer. And plus I've been in New Orleans for 2 days, so I'm not sure I want to look at alcohol again yet until maybe a couple more hours. At least the sun's got to go low on the horizon. But anyway, so
with your skin, Bobby, right? It's probably coming out of
exactly.
yours.
Exactly.
So does the Fed pause in the next 3 months, Nancy?
Well, I think it's more about what's priced in, right? Just like I hate people who are like always like they know, or they're macro pundits who like have this prediction about what's going to happen. For me,
wait, you literally hate us? Go on.
Hey, I personally am not one of those. I just go in facts. What's priced in?
I'm kidding.
So
Yes.
what the numbers are is right now I'm looking at Fed Fund futures. I can share my Bloomberg screen if you want to see it, but we have 141 basis points priced in the next 2.5 months. Today is October 14th. So we got till the end of the year. The Fed has to hike 141 basis points just to meet
3 meetings.
Expectations.
3 meetings.
Just to meet expectations, yeah.
No, I know, but that's November 2nd meeting. Hold it. So the next 2 meetings, the Fed funds is saying 141 basis points.
It's almost 75 basis points per meeting. And
Okay.
if they hike another 75, that would be really unprecedented since the 80s to have, 4 hikes in a row of 75. And then you have 140 priced in. So I think it's really skewed to give investors there's lots of room there, right? There's a lot of things that could happen into the end of the year, obviously, the better the econ data that comes out, like the better the jobs number, the higher the CPI, the higher the PPI, like all this good economic data just prices more and more and more Fed hikes into the market. And I think that's probably because there are just so many macro tourists out there who don't actually see what's priced in. You're looking at a lot of people use like probabilities, and it's probability of this, the probability of that. I just feel like there's lots of speculation. And I think very simply, and maybe on Twitter when this thing gets posted, or on your whatever social media, we can send the codes so investors can pull up Fed fund futures themselves to see what's actually priced in, just to stick with the numbers. And then
No, I like it.
You can make your own view about whether you think that's going to happen or not. But I think the first thing that you have to stake in the ground is, what does the data say? Because interest rates, just like all markets, they move off of expectations, not reality. So you often have, like, even with Powell, if you looked at December 2018, we had a different president, the rates market had priced in for 2019 3 hikes, right? That was what was going into the December 18 meeting. What did the Fed do? They ended up cutting 3 times, even though you had 3 times priced in for hikes. So the rates market is often wrong, even with Chairman Powell still is, and there was no pandemic, no inflation, no geopolitical situation, no UK. There's literally nothing going on. So I think there's a lot of room for a pivot, because you have 141 basis points of hikes priced in, plus you have a little bit more priced in the following year in 23.
Okay, Bobby, I'm going to ask one more question and then want to get you in if that's cool. But first of all, for people who are watching too, one thing, a shortcut of what we were just talking about is on the CME website, they have the CME Fed Watch tool, which calculates the Fed funds futures curve and gives you different probabilities for events at each of the next meetings. It's very, very useful, I think. But on the panel I was on this morning with Peter Bookbar and Dave Collum, everybody kind of agreed that the Fed is going to keep hiking till something breaks. First of all, I assume you agree with that, till they see some destruction. What is that destruction going to look like, provided you do agree?
I mean, things are already breaking, right? It's
okay.
Like it's been one of the worst years for 60-40 portfolios. My heart goes out to those people that have saved, think about saving your whole life, retiring, having your golden nest egg, and then, the NASDAQ and the 20-year treasury are down both 30%. That's devastating to people's financial life savings. It's also devastating because if you're not, say you are retired and you're not in the labor market anymore, the cost of living is so much higher. Like, even though the market is saying future inflation expectations are going to be really contained, the market really thinks the Fed hiking rates is going to reduce inflation dramatically in the future. Realize that people are living with realized inflation at 40-year highs. And so everything is more expensive. And so I feel like the Fed's already, they were so wrong to not hike rates sooner. They were so wrong to stick by, the stubborn transitory comment. But I think that's where there's an opportunity for investors, because even though the Fed retired that word, the market hasn't. And the market is priced for the Fed's rate hikes to kill inflation. And that to me is a real opportunity. Buying future inflation expectations is really low. And that, I think, is very surprising to a lot of people. With realized inflation at 40-year highs, why would it be so cheap to own it in the future? And that's because the market believes the Fed. They believe that the Fed hiking rates is going to cool inflation. And that I don't think is necessarily right, because it doesn't, especially now that you have some, not to get political at all, but the facts are some states are sending checks now to people as inflation relief. So, not a political statement, but just that is.
But we don't care. By the way, it's a policy statement. I mean, we are people who look at macroeconomic policy, and that is asinine, buffoonish macroeconomic policy. It's like they sit around going, what's the worst thing we can do to fuel inflation? Oh, hey, I got it. Let's just throw gas on the fire. They're a bunch of dumb shits. Or it's even worse than that. It's nefarious. And again, that's not a political statement at all. It's just policy. Robert.
Yeah, my question goes towards something you just said. My questions are usually really long. I'm going to keep it short. Do you believe the Fed? In other words, the market believes that the Fed is going to tamp down inflation. Do you believe that?
I think the Fed hiking policy rates is definitely killing demand, right? I think it's, consumer sentiment, small businesses, like a lot of people have, we're at levels from 2008. But I think the market is giving, like, I want to shake retirees and be like, buy inflation protection because it's so cheap to own future inflation expectations. Just like the rates market is a huge market, right? Most people don't have it inside their portfolio because it's not stocks and bonds. It's not as sexy to talk about interest rates, stocks are more interesting, or companies are more interesting because you have stories and you have narratives and you have great CEOs with management teams. Interest rates are more boring, but I do think it's something that every investor has exposure to inflation. And I think the market is really giving you future inflation expectations at very low levels. And I think that's a great buying opportunity for investors to say, look, forget trying to predict whether inflation is going to be higher or lower. Just look at the numbers. The numbers are saying it's not expensive to own. The yield curve is the most inverted it's been in the swap space since the late 80s. Owning long dated bonds, like literally I'm looking at the 2-year swap rate right now. So that's the 2-year interest rate. That's the unfunded market. You have to remember, the world does not spend money to buy government bonds. They use leverage. So not looking at the treasury market, look at the swap market. It's 5 times bigger than the US stock market. And right now the 2-year swap rate is 4.86. I see on my Bloomberg terminal. I'm happy to share screens if you'd like to share it, but 4.86. And the 10-year is 4. So 4 versus 4.86. So you actually are paying almost like a tax to give the US government money. Like when the money for 10 years get paid 85 plus basis points lower to take more risk. And so you just have to be really careful that owning long dated treasuries is not some safe haven trade. Long dated treasuries has lost as much as the NASDAQ this year, and we have an inverted yield curve. So it's just really important to say, look at the facts. It's not, what do you think it's going to happen? It's every market is the same. You want to buy low and sell high. And inflation is priced for it to cool dramatically in the future, even though realized inflation is at 40-year highs.
Bobby, I think I can boil down that answer. She's saying Fed's full of shit, market's full of shit, inflation is going to stay high, right?
I'm not making a call about whether inflation is going to stay high or not, because it's just what
cheap.
it's priced
Yeah.
in.
It's a probability.
She's basically saying, I'm going to paraphrase here, the owning the possibility of that happening is inexpensive.
Yes.
In theory. So
Brilliant.
I guess I'm actually going to ask a really long question now, because I feel oddly vindicated with people so I said the June lows weren't the lows. By the way, I'm not breaking my arm, patting myself on the back. I hoped they were. I don't like to see people suffer with their, and there was just so much of just an automatic buy the dip crowd out there that is just getting smoked. I don't like seeing retirees get hurt at all. I know a couple of them personally, and I don't want to see them get hurt. But interestingly enough, from a perspective of what I think, and maybe you could shed some light on this, I think sometimes consumers think that if the Fed stops or pivots, which are 2 different things, then everything's okay. And I have a friend who said, I think the Fed, he has no basis to think this, but he's just like everybody else. He follows the news. And he said, I think the Fed's going to stop raising rates by December. And, then housing prices will go back up and my 3-year arm will be fine in a couple of years. And maybe you could shed some light. It's not a 1-for-1 thing, right? I mean, if the Fed stops with rates at 4.5 or 5, or I have a friend who thinks 6, that bleeds in for a while, does it not?
Yeah, no, affordability, you kind of need, it's like, I think of your personal ledger, right? Like you have a personal balance sheet and you have the amount that you're paid in your job, right? So you have your wages, and then you have your cost of living. So the problem is, if you're not already in the real estate market, if you don't own a home already, you haven't benefited from the increase in property prices, and with interest rates higher, you need more wages to be able to afford the same, same whatever number you want to put on your home. You need more money to pay for the same home because of the interest expense. And so that's where we have, I think that's why I think it's so important for people to have interest rate exposure in their personal portfolio. Most people just have stocks and bonds, even though real estate tends to be the bulk of people's life savings, is when they do purchase a home and they have that. I read a stat somewhere saying that 80% of the world's net worth is in real estate. And so I think it's super important to not only look at stocks and bonds, and to have also exposure to the interest rate markets, because most professional real estate investors, they don't sit there and say, gosh, fingers crossed, I hope the Fed doesn't hike rates, right? They go and hedge themselves, whereas regular people don't. And that's part of the reason, I started my firm almost a decade ago. We tried to give access to markets that people don't necessarily have, like things you can't necessarily trade on your iPhone, which is the interest rate markets. I think it's a super important thing for people to have as part of a diversified portfolio. It's not always going to make money, but it doesn't look like everything else that people already have in their financial portfolio. And I think interest rates are super important for everybody, even if they're not taking a view about what the Fed's going to do, what the Fed's not going to do. And the thing I really wanted to get across by coming on your podcast is tell people forget the 1970s. Don't look at, only what happened in the 70s when you're thinking about stagflation or inflation, because the inflation markets didn't start until the late 90s. The interest rate derivative markets really didn't even start until, more like the 2000s, when options really started trading and all these other financial products. And so a lot of people look at that old school stuff, and I think it's just so obvious to own inflation as part of a diversified portfolio, because we just don't know, the Fed hiking policy rates isn't going to put more truck drivers on the road, or it's not going to make Russia not invade Ukraine, or it's not going to solve the global amount of sovereign debt out there, and the amount, there's so much leverage in the financial system, and asset prices are extremely inflated around the world.
So here, just for clarity, this is kind of a housekeeping question. So you're saying exposure to interest rates, but you're saying stocks and bonds, but in your mind, you're saying a bond is just a fixed rate. So you're saying exposure to yields moving, which would, right? Is that correct, first off?
So I manage a fund that accesses the rates market. It's called eyeball, not eyeball, but eyeball,
eyeball,
interest rate
right.
Volatility. And
Got
it gives IVOL. I know it always sounds like I'm saying eyeball, but it's eyeball, interest rate or inflation volatility. And that gives access to the OTC markets, which are the rates markets. You don't necessarily want the treasury markets, because that's A, where the Fed conducts their QE purchases when they do it, and B, it's not the global market. And nobody, UK, perfect example, nobody pays for government bonds. They all use leverage. So
right.
The swaps market is huge. It's global. Whenever you have, whether it's a sovereign bond, a sovereign issuer like Kingdom of Saudi Arabia or AstraZeneca or Disney, whenever they issue a bond in US dollars, they turn around and hedge their rate risk in the swaps market. And that is a huge market. And it's something that most people don't have exposure to, whereas they just have stocks and bonds. And so
makes sense.
I think it's just a really nice diversifier where you can have that something that doesn't look like everything else.
Bobby?
Yeah, so I'd like you to go into your products a little more, if you don't mind, simply because I think for a lot of people, when you say exposure to the interest rate markets, they think exactly what you just said. Oh, Nancy's telling us that we should own bonds. So from a perspective of owning inflation, can you go more into that? And also, I don't remember the second part of my fucking question, so go ahead.
That's the bourbon. That's the bourbon that does that to you. And age.
Very nice.
No,
Hey.
we're not very nice here, Nancy. We're not very nice. You need to take a shot at somebody before you leave, or else we're
You
going to
have
keep you
no
all
idea.
afternoon.
Like,
No, I'm
No,
just giving him lots of love. Bobby, you're
No.
not old. Don't listen to him.
Oh, don't listen to him.
Jimmy and I have known each other for coming up on 30 years, and I don't think I've ever heard a nice word toward me come out of his mouth unless I wasn't in
Not
the
a
room.
word. Right,
Unless I
not a
wasn't
word.
in the room.
I think he
Then
shows
there's nice
affection
words, yeah.
by teasing
Yeah.
you.
Yeah.
Exactly. It's
You
affection.
flirt
Yeah.
like you're a 14-year-old boy.
See,
He's built
now
like
we
one,
got her
too.
going. Oh,
He's built like a 14-year-old boy too.
okay,
Oh, you would
that's
know,
good
right? Feel the love.
stuff. See, it's getting more fun now. Bobby, what was your question again? Oh, going into your products. Yeah.
Yeah, go into your products. I think it's really interesting for people to understand what you do and exactly what you guys offer with Eyeball.
Yeah, so most of it is treasuries. So that's the first thing. It's using inflation protected treasuries. So about 80+% of the portfolio by mandate and our prospectus has to be treasuries. We use TIPS, which are inflation protected treasuries, but then we try to fix the problems that exist with TIPS. TIPS have two issues in my mind. When I started my career at Goldman in the late 90s, it was right when the Treasury invented the TIPS market. And I remember as a young trader just thinking, this is not a great idea because TIPS only reset with one single index, and that is the consumer price index, exactly what it says. And CPI is just one index. It's not the only way to measure inflation. I would compare it to, in equity land, nobody would ever buy, say, the NASDAQ or the Russell or the Dow Jones and say, ta-da, I have the US equity market. And they're more ETFs than stocks, right? There's so many different ETFs. So it's like, why would you use one index to measure the equity market? It doesn't even, inflation is huge, right? It's like much, much bigger than the equity market. So I just don't think CPI is the only way to measure inflation expectations. It's an index that's created and set by the Bureau of Labor Statistics. So every time I go to the DMV, I think about it and I'm like, yes, 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 this is much better. So we take that core TIPS portfolio and then we try to give access to another measure of inflation expectations outside of CPI, because CPI, a third of the calculation is rent. It's shelter in the form of owner occupied rent. So it's lagged because leases are typically 1 year. It's not just the only way to be thinking about inflation. I think a very simple way to think about where inflation is using interest rate differentials, right? Because, if I was going to lend you money, Bobby, for instance, and you said, could I borrow
Don't do that.
$1,000? I'll probably charge you a big credit spread. But if I look at the rates market to give a sense of where interest rates, if I lend you money for 10 years, I should get paid less right now as a lender. I get paid 85 basis points less. And that the Fed sets policy rates, just like every central bank in the world sets policy rates, but the term structure where interest rates are in the future is set by the market. And right now the market is saying, we believe the Fed's going to hike. It's priced in. You can see that into the level of 2-year interest rates or 1-year interest rates, or even like a 6-month T-bill. You can see the hikes that are priced in, but the market says the Fed hiking is going to cause this disinflationary low growth environment. And there's a negative premium to own long dated treasuries, long dated US dollar debt. And so I think it's a great opportunity for investors. And that's what we capture inside Eyeball. We have this core TIPS portfolio. So about 80+% of the portfolio is treasuries, but then we add interest rate options to capture another way of thinking about inflation outside of CPI.
I remembered my other question.
Yeah, good.
You mentioned that you don't make money all the time in something like this. And I'm assuming that's versus what most people would be looking at. So I was a co-CIO of a fund of funds for 8 years. And the worst thing was trying to explain to people about non-correlative assets and trying to get people to understand that despite the S&P being up 20%, our 9% was good. right?
Yeah.
Did you struggle with that over the last, I mean, you founded your firm a decade ago. So you essentially were trying to get people to look at interest rate exposure while stocks were up like 400% a year. I'm obviously exaggerating. Is that a difficult thing to get people to understand?
I think it depends on who you're talking to. Like most of our clients that I speak to are on the institutional side. And so I think it's like, but very simply, if we compare it down to say correlations, I would say very simply, if everything in your portfolio is making or losing money at the same time, you are not diversified, period. So you want things that are going to make money when other things are losing money. And the traditional portfolio is a 60-40 portfolio, which is really not diversified, especially on the bond side. It's really a pet peeve of mine that most investors on the bond side are using things that are referencing the ag index. It used to be the Lehman ag, and then it was the Barclays ag, and now it's called the Bloomberg ag. But it's a really, really, really old index that's market cap weighted. And because it's market cap weighted, the amount of mortgages and treasuries is super high. And so it's not that diversified. It might say, core fixed income, but it's really not diversified. The ag has two big holes, in my opinion. Number one, it doesn't have any inflation protection in it. It's got 45% is nominal treasuries, meaning regular treasury bonds. That's because there are no tips. So no inflation protection. I'm like, why would you want to take a bet that there's not going to be inflation? And number two, and this is more, really, really important. I want to super stress this to viewers is you have to be careful with mortgages. Mortgages, I want to slap people and be like, didn't we learn anything in the financial crisis? The Fed owns a lot of mortgages on their balance sheet. They're doing quantitative tightening. If you just close your eyes and you think about what a mortgage is, if you own financial mortgages, of which the Barclays Ag, a third of it is mortgages, homeowners are long the option to prepay. They can prepay their loan whenever they want. Whenever you're long an option, you're long volatility. And whenever you're short an option, you're short volatility. And so mortgages are actually short fixed income volatility. So on financial media, there's lots of attention around the VIX index, which is equity vol. But the reality is most people in their bond portfolio are only short fixed income vol. And that was part of the motivation to create iVol, because I want to give people at least a way to neutralize that short volatility. Our fund owns volatility. So we're long fixed income vol because we buy options. Very simply, whenever you buy an option, you're long vol. And whenever you sell an option, you're short vol. And so I just think it's a real problem for investors, especially retirees that have the ag thinking, I'm diversified, and they really aren't that diversified because they have no inflation protection and they're only short vol from the mortgage exposure.
By ag, you mean aggregate. I just want to throw that in and see.
Okay, thank you so much for that, Bobby. I thought agriculture several times when you said ag.
Yeah, it's the ag.
I know exactly what it is now. Yeah, I remember it.
Yeah.
I remember we sometimes trade commodities too. So I was like, God, no, I got it.
Yeah.
But so do you, as your funds, your investors, you're not pitching this and selling this as something that's your 100% investment, correct?
No.
This is a hedge against a lot of different things, and assuming that people and institutions have equity exposure as well, correct?
It's not necessarily a hedge against a lot of things. It's just something different. It's
something different. Okay.
It's a lot of people will take their core fixed income portfolio and say, whatever, say it's a 60-40 portfolio and they have the ag index, the Barclays aggregate, now called the Bloomberg aggregate, as core fixed income. They'll take iVol and add it in to make a more diversified bond holding. So
have you ever thought of changing the name of it to eyeball? That would be kind of cool too.
Eyeball?
Yeah, because everyone thinks you're saying eyeball anyway. So
I don't know how you'd make that a ticker. I think eyeball is a 4-letter word. Maybe you can.
Good point.
Right.
Solid point. Okay, so here, do you want to talk equities at all too? Do you have an opinion on equities over the next quarter, the next half year?
I think equities are generally a decent thing for people to own long term. I think you just have to be really careful in today's environment because you don't want to say, oh, I have stocks and bonds and I'm diversified, because a lot of people they might have short duration bond funds, but so it doesn't take, maybe I can start in a different way. There's only two types of bond risk, right? There's rate risk and then there's spread risk. And so the problem that I have with corporates is that a lot of people, like, very simple, if you own, I don't know, Apple stock, Apple bonds, you still have the same corporate risk, right? If Apple has higher labor costs or a global chip crisis or a bad product or a bad management team or supply side issues or falling consumer confidence or recession, you're going to get hit on stocks and bonds. So I think the important thing for me is, like, have your equities, but try to diversify away from credit. If you have a portfolio that has a lot of stocks, which are corporate beta, and then a bunch of bonds that have spread risk to corporates, you kind of have the same thing. And so that's kind of where I'm saying, look, our strategies don't take credit spread risk, they take interest rate spread risk, something different, not always going to make money, does involve a different type of risk, but it doesn't look like corporates. And the real problem that people are having this year is that stocks and bonds have sold off together, right? And especially credit spreads really haven't widened very much. You know, the investment grade credit spread, it's about 100 basis points right now over treasuries. It's not, we're not having a credit crisis at the moment, you know, knock on wood. And so I think it's really important to just make sure, don't go by name only. So if your strategy, if you have a lot of short duration thinking, oh, I'm not risky, right? I'm keeping it short. You're not taking a lot of rate risk, but a lot of those strategies, if they're not all government, take a lot of spread risk. And there's all sorts of, like, things inside these funds that are, you know, anytime you see 3-letter words, acronyms, like, you know, these are all structured credit investments. Some of these funds have CMBS, which are commercial mortgages, structured credit, ABS, MBS, all these words. You just have to pay attention to what you own, because even though it might say short duration, some of these short duration products, 85% of the risk is BBB minus credit, you know, and that's just, so I think for me, it's not a problem owning equities long-term. As a long-term investor, it does make sense. And the market is super bearish right now. Definitely everybody thinks bad things are going to happen. But that could be a great opportunity for people who can sell, you know, maybe credit and own more equities, because you have a lot more upside with that. With equities, you still have the same corporate risk, but you could have multiples expand or EPS go up. You know, yes, maybe it'll be doom and gloom and we will be in a recession, but just be careful not to have the same stuff. Just because it says stocks and bonds doesn't mean that it's necessarily any different.
Bobby, I'll let you get the last question before we goodbye, but something dawned on me we were talking about, because I thought we could, if we package BBB minus a bunch of them together, then we wouldn't have credit risk.
No problems.
Right.
What could possibly go wrong? I mean, I was told that. Bobby, what do you got?
Well, I love the diversification conversation because it used to drive me crazy. Jim Cramer, back when I would watch him for 4 minutes, used to have a part of his show when people would call up and list 5 stocks and he'd tell them if they were diversified or not. And they'd be like, I've got McDonald's, Abbott, Apple, Schlumberger, and Goldman. He'd be like, you're diversified. Don't worry about it. It's like, dude, you got 5 stocks. Okay. If stocks go down, oh, I don't know, 28% like we have now, you might get hit on all 5 of those. So I love that explanation. I maintain that stagflation is a bigger ill than recession, or inflation in general is a bigger ill than recession. You have an opinion on that?
Yeah, I think stagflation is definitely a non-zero risk. Let's define it. Maybe that just means higher prices and lower growth. You know, there's no guarantee that the Fed hiking policy rates is going to have any change on prices, right? It's not going to fix the labor market. What some states are doing is probably creating more of a labor shortage, and the labor shortage is global. There's, you know, there are too many job openings without enough people to fill it right now for whatever reason. We could speculate that in another podcast, but the reality is that wages have to go up to retain talent, and a lot of supply side disruptions are still happening because of the labor market. And so there's no guarantee that the Fed hiking policy rates is going to cool inflation. It might just stagnate growth. And that's where the 60-40 portfolio is especially at risk. And in historically stagflationary periods, credit is actually one of the worst asset classes to own in stagflation. So I think it's just super important with bond portfolios, especially if you're not in the labor market, you're not working, you're not going to benefit from wage increases, going back to your personal balance sheet, that you add inflation protection in your financial portfolio, especially because it's priced at such, extreme discounts to where realized inflation has been.
I love that answer. There's one more question I had about supply chain. So you mentioned that the Fed doesn't control the inflation as much as they would hope to. They can crash the demand as much as they want, but if supply chain is still the issue, that will remain the issue, obviously, right? So, and Cameron, when she was on the show, and Cameron, I defer to on everything, but there's one thing I've pushed back on, it's been stuck on me. She thought taking the pressure off the supply chain by destroying demand through the Fed would help the supply chain. To me, that seems paradoxical. To me, it seems like pressure on the supply chain will help it heal itself faster. Do you have any opinions on that?
I think so much of the supply chain disruptions are, things that the Fed cannot control, right? They're just hitting, they're hitting the same nail with a hammer over and over and over again. And they're actually creating more global problems because emerging market countries are in distress. It's becoming, we're at the point where like we could be having another financial crisis, like a financial stability issue, because like look at just even developed market countries, how strong the dollar has been. So it's definitely a very challenging time for investors. And I think the two takeaways that I just want people to know about is be careful with mortgages. Just remember that they are short vol. The Fed has said that long-term, they don't intend on owning mortgages in their balance sheet, and somebody's got to buy that stuff as it rolls off. So just be really, really careful with mortgages because they are short volatility. Make sure that you're not only, you never want to be one direction only in a portfolio, and that's only short rate volatility. And that's part of the reason we created these products to give access to long rate volatility. It's gone up a lot this year, but inflation expectations have fallen. The yield curve is actually the most inverted it's been in the swaps market since '88. There are not many things that you can buy in the financial world that are trading at valuations from the '80s, and the yield curve is so incredibly inverted. It doesn't make a ton of sense to me. But I think it's just the bond markets, the rates markets are saying the Fed is making a policy mistake, and they're going to kill growth.
A deflationary, a recessionary, potentially even deflationary policy mistake. Correct?
Yeah, think about it. Like, why would you ever buy a bond with more duration and get paid less yield? Right? You do that when we're like sticking JGBs under the mattress. You do that when you think there's going to be disinflation or deflation.
It's so funny because every time somebody says that the Fed is going to go too far, my mind immediately goes to they're not looking at the same thing you are. It's like,
but they will be, Bobby.
If you have a friend that's an alcoholic, for example, right? You're like, you're drinking too much. He's like, I'm just fine. That's what the Fed seems to be. We're all looking at, the Fed's going to drive us into inflation. So they're going too far. I'm sorry, into recession. So they're going too far. And I think they're sitting there in the room saying, of course, we're going to cause a recession. We want to, we just can't say it.
Right. They actually have kind of said it, which is fascinating to me. So Nancy, I have a question for you. If we can buy in now, we're going to go over what we do on the show is we have the macro guests, which have been wonderful. Sometimes they stay on to critique our trades and tell us how much of idiots we are. And sometimes they don't. And by the way, it's Friday afternoon when we tape this. We don't have any hard feelings either way. Bobby, you have a trade today, right?
Yeah, I do. I just didn't send it to you because I was running late today.
That's fine. Nancy, you want to stay with us or you want to go? Again, there's no hard feelings either way.
I guess it depends what it's like. Is it single stock?
Oh, we're trading. No. We're trading. It's always futures products. I'm trading Ethereum, E-mini, micro S&Ps, and Bobby's trading what? Crude?
Crude.
Crude. Do you want to stay?
Probably better for me not to. I'm not allowed to give financial advice.
God.
I'm not a financial advisor, so probably.
Sure. God, I can't believe you'd insult us like this by leaving us on Friday afternoon. I'm totally kidding.
Very
Going
upset.
up, very upset. Where are you going? Are you going out tonight? It's Friday night. Are you going out to a bar? Are you going out to dinner? What are you going to do?
I don't know. I'm wearing my pajamas right now, so I'll have to get out.
That should be the opening, Bobby.
I'm wearing a onesie.
So you're not going out anywhere, are you? Right.
Nancy's a
this
Florida
scarf
girl,
covers
that's
it,
why I
but
like
no,
it.
I'm wearing a big old onesie and not dressed to go out at all. But
Yeah.
How long have
Bobby,
you been
I
out
totally-
of Florida? You're a Florida girl, right?
yeah,
How long
Yeah.
have you been out of Florida?
a long time.
That's a shame. Come back.
But my
We miss
parents
you.
are still there.
We miss you. Come back.
Bobby, I started the show without doing the lightning round with any questions. I told just because I'm out of my element because I'm in New Orleans. I apologize for
Hit her
that.
with those before we say goodbye.
Before we say goodbye, we need to do the lightning round, by the way, and you will be judged on your answers, and you have 5 seconds only for the answers. And nobody knows what the questions are, including me, until the sentence is finished. Okay. Favorite actor, 5 seconds. 5.
Natalie Portman,
Nice.
Wow.
Favorite movie, 5.
Dumb and Dumber.
Hold on a second. Time out.
Do y'all love me?
Outstanding.
Stop recording.
That is outstanding.
Okay. All of a sudden, a stray dog shows up at your doorstep. You decide you're going to keep him. What are you going to name him? Go. 5, 4. You thought this was going to be easy, didn't you?
No, I did. Casey.
Oh, that's a cute name. Okay,
I
good.
thought for sure you'd go with eyeball.
Eyeball would have been perfect. Eyeball would have been correct, but we also will accept Casey.
Eyeball is now the name of my next dog for sure.
Right. All right. See, we usually start the show with that. It's a nice little icebreaker. We forgot to, but thank you so much for being on. It's been a gas.
My pleasure. It's really nice
you've been
to
great,
connect
Nancy.
with
Thank
you
you.
guys.
So, okay, I'm looking at Ethereum, and I have Ethereum, and I don't. If I'm going to put this trade, I'm not sure. I'm probably going to wait till Sunday night if I do.
Mhm.
Ethereum has been a surprising. It hasn't gone down as much as I thought it would over the last couple of weeks. Yeah, and even over the last week, Google came out, said they're going to be accepting the big two cryptos for cloud payments. The Bank of New York Mellon, the America's oldest bank, decided they're going to take on custodial services for crypto portfolios, and the New York financial regulators said they would. So to me, it's like oldest bank in America, Google, new flavor, like broader adoption seems to be happening. So I'm liking Ethereum, and so to me, it's a technical trade again. If Ethereum trades 1350, this is the October micro Ethereum contract, a stop in. We talk about this sometimes on the trade, which is sometimes counterintuitive to newer traders. I want to see some strength, and that's where I buy it. I could buy it at a better price right now, but I don't. I want to see some momentum higher. Buy it at 1350, target 1750 on the upside, and stop placed below 11, placed at 1160. This risks $190 to make 400. Both the trades I'm given today seem kind of like much more reward than risk, and that's because both of the things I'm looking at seem to be on very, very important support levels that if they're broken again, I think forget about it. What do you think, Robert?
So I love the direction. Ethereum's kind of been in a little bit of sideways channel since the fall that started about September 22. And I'd say it kind of formed this channel. Since the drop that started at about September 12th. And it formed this recent channel by kind of entering into it about September 20. So I love the direction. You're getting in earlier than I would. What I'd rather see it break above the top of the channel, which would be somewhere in the 1360 to 1380 range, come back down and test it, the top of the channel, and hold. And then I think you're off to the races. But I like the direction because you're getting in above the midpoint of the channel. So it's likely to go to the top of the channel and you'll be in the money at that point. You could decide to adjust, change your stop, whatever.
Do you see why I picked that level?
Yeah,
that was just above yesterday's high.
So not the Bitcoin Cash. I actually appeared on CoinDesk
Ether.
TV this week. I did CoinDesk TV this week. And when I was preparing for the interview, I was looking at Bitcoin. And I'm like, wow, man, Bitcoin it actually fell post CPI to levels not seen since 2020. I had to correct myself. That was the futures. I didn't say it on the show, but the futures fell to levels that we hadn't seen since 2020. Ethereum, I don't know why I call it Ethereum, fell to levels we haven't seen since July. So
Right.
it's certainly stronger. And I
Yeah.
like that over Bitcoin as well.
Got it. Okay, good. Let's go to crude. Which, by the
So
way,
crude
for
oil-
our viewers,
Go ahead.
Bobby has killed the crude trade over the last month. Just very, very nicely done. What do you got?
Yeah, and this might actually be seem counterintuitive to people who know that my larger case is bearish on crude oil. I actually believe we'll see 65 before we see 100. I might jack that 100 up a little bit, the way it's been trading lately, but we obviously had a big down day. We're recording this on Friday, and we're just seeing that big down day in WTI crude. What did it get to? About 3.7% lower all in on crude oil. I want to buy if I can get a move above 89.30. Now, since I'm saying a move above, I'd rather see a close above. So I'm going to go ahead and put my entry at 89.40 instead of 89.30. Okay, just to kind of give it a little room. And people are looking at it, they're like, oh, I bet you bought 89.31. You didn't really get in, right? I would like to see it sit up there a little bit. My stop's going to be 82.75. My target's going to be about 96.45. So that will be a 665 risk on the micro crude futures this December micro crude futures, $665 of risk, $705 potential reward if it gets to my target. It's a trade, and it's a shorter term trade. I still maintain that, given a lot of the data we've seen over the last couple of weeks, that crude's still likely to be weak. I mean, you think about it, man, crude finished this is the week after a production cut. Crude had one of the worst weeks since like August, down 7.4% on the week after
Right.
a 2 million barrel stated production cut. So
Yeah,
I think
which
we
seemed
go
like a
little
huge
higher.
deal. Yeah. Okay, so I like that trade a lot. I think that the production cut was a big deal. I think the realization about that we have to eventually at some point in time fill the SPR back up after draining it irresponsibly prior to an election, which is, I mean, just there's no other way to describe that as absolute political bullshit.
Absolutely.
That they're selling CPI, the SPR, well, when crude is at a very reasonable level of 80. But anyway, that's neither here nor there. I think after the election, they're going to start talking about, oh, shoot, yeah, we shouldn't have done that. Maybe we got to fill it. So I am somewhat bullish crude on the upside.
Yeah.
I do probably think 100, but I haven't been scouring the technicals like you have as well, but I like it. So now this next trade, I'm going to talk about buying the micro S&P. I am actually short a handful of micro S&Ps against some options that are going to be gaining significant delta above this. I got some trades on that I really love where I'd like sell 30 wide call spreads to buy 80 wide call spreads above it, like selling an imbalanced call fly. Does that make sense, or do you think I have to go through it?
To me, it does.
Okay, good. Well, because my trade's going to be
you
much
explaining it though, because that's like a bearish trade with a bullish kicker. I mean,
exactly.
Yeah.
So what it is, and I will take 5 seconds on it. Usually people buy a fly, an equal weighted fly, like they buy a call spread and they sell a call spread with the two calls at the same exact price and the two widths of the call spread the same. So they want the market to makes the money on expiration if it goes and settles near that middle strike. I like to create imbalances in the call spreads because then you can make directional bias. So sometimes I buy the bigger downside call spread. I like this with the fingers, with the bigger downside call spread, and then you can sell the upside call spread, and you make whatever the difference is here. If you get to that middle level, and you can't lose it all when it goes above it, you still make the difference. But now what I'm doing is shrinking that first call spread way down, selling that call spread, and then buying the big ass call spread above it. So it's a bullish trade, even though you're selling a call fly. So again, if anyone wants to really dig down deep into it, just contact me on Twitter and I'll give you Bobby's home phone number and you can call him and explain it. So I'm talking about now the Dees Micro E-minis, buying it at 36.10. So 3,600 is such obviously important level. And I don't know if you saw where we're going to close, where we're trading right now at 324. Friday, we're trading at 3,600. So it's giving us no help. 3610, it's 10 ticks above where the market is, which again is a hair width above where it is. But anyway, I want to stop in there at 3610 and target 3695 on the upside and a stop place below 3570. Again, 3570 level is chosen mostly because 3600 is such a big deal to me level wise. So that risks $200 if you stopped out of your level, makes $425. Another reason I do this too, before I get your comment, is that yesterday when we broke hard after CPI, the VIX went down. To me, it seems like there's a lot of people positioned for downside. And that's one of the reasons we saw the whip around yesterday. And I'm not saying anything is over by a long shot, but I am saying we could have a bit of a relief rally. Thoughts?
So a couple of things. First of all, I have been so wrong over the last couple of days on equities. I didn't trade them at all. And full disclosure, we did our CPI live stream on Path Trading Partners post CPI conversation. And I told everybody watching, I think there's almost zero chance of us turning positive. And then we went and not only turned positive, it was a killer day. I did not trade. And I told them on the live stream, I'm not going to short it, but I just don't think we'll go positive. So then we did our afternoon live stream and I said, yeah, it's a follow through. I think it's going to be up huge tomorrow. And as I'm looking right now, the S&P is down 2.25%, the Nasdaq's down 3%. Didn't trade that either. So I'm going to go ahead and shut my damn mouth and basically say that I still think, I maintain that the fourth quarter will be positive versus the close of the third quarter. Okay. So I think just this quarter will be positive. We'll still end up obviously down on the year. But I think next year in the beginning is going to be very much a struggle because I still, my main point on all this stuff, Jimmy, and I'm going off in a different direction because I can't give an opinion on a trade because I've sucked lately. So I'm going to leave that to you. You're going along with some core shorts. Is that fair?
Yeah, exactly.
Okay.
Yes.
That's fair.
So if the bottom
shorts,
drops out, I'm fine. Yeah.
Core shorts, short-term long. I got no problem with that because I suck. If you listen to me on equities this week, you're pushing an ice cream cart in Pilsen. So from this perspective, my whole thing on this is that, and I said this to Scott Shelley this week, and he made a big deal out of it. You should never underestimate the Fed to do the wrong thing from our perspective when the market is screaming in their ear to do something different. And I just don't underestimate them. And they keep saying the same crap. And the second thing I'll throw in is that this Fed, if they've been consistent about anything, they've said what they're going to do before they do it. Even Powell's Jackson Hole, where he's like, I think it was Jackson Hole, where he's like, we got to fight inflation. That's it. And then they went on the 75.
And then he left. Right. Yes.
And they keep saying that. It was a very short conversation. They keep saying the same thing. So based on the tool you mentioned to Nancy, as of when I looked at it yesterday, it was a 93% chance of 75 in November. There was a 54 or a 55% chance of 75 in December. And then they were still pricing in higher probabilities of hikes in February.
See, I think that's crazy.
Yeah, it's crazy, but they just might.
They might. Yeah, they might. Right.
They might do it. And you and I will sit at home and watch the economy collapse. And I'll feel vindicated and I'll feel like shit for people.
Shit, right. And that's the best part of that movie, The Big Short, was the Brad Pitt character when those guys are like celebrating. He's like, no, we, because that really hit home to me. This is mass spread shittiness and we just made money on it. But again, it's our job to do that. Yeah.
Just because we never talk about movies and shows. I mean, you mentioned The Bear, and it was just The Bear is just so good on Hulu.
Awesome.
But between the two movies, Wolf of Wall Street and The Big Short is so much more realistic. Wolf of Wall Street, all that stuff happened, but not in the same damn day like they showed it. It's usually of course about 3 to 5 years that all that stuff would happen. And the movie made it sound like every single day they were taping hundreds to boobs, and just I hated that.
There was taping hundreds to boobs, but again, it didn't always happen the same day.
The Big Short, if you haven't watched it, watch it.
Oh my gosh.
Questions, hit me or Jim on Twitter. We'll answer the questions. So good.
I try to watch it every year. It brings back the same feelings though when the bottom was dropping out, and it's Terrifying. Before we go, I want to say that when I did the speech this morning at the New Orleans Investment Conference, and I used Mike Arnold, of our very own technical analyst, Path Trading Partners, some of his technicals for the long-term trades I was talking about in copper, platinum, and silver. And when that comes out, hopefully we can release at least parts of it through
Well,
this.
for sure. I
channel
was
as well,
actually
too.
gonna say to you, if people can still like buy your speech or find your speech or
I'm
something.
I'm not positive. I'll ask
Yeah.
somebody though.
Find
Yeah,
out for
so-
next podcast, but if not, we'll grab clips of them. We'll definitely release it. We're going to start something called Futures Edge Shorts, which are going to be little 3 to 5 minute videos that we'll put out on YouTube and maybe on Spotify too. But we'll throw those up and we'll include it in shorts, little parts, and Mike's excited about those too. So that'll be fun.
Good. Mike's the best. Thank you guys so much. I'm going to take a nap before we're going out for a Cajun dinner, going to the Creole House tonight, and we're going to live down the Frenchman
Nice.
Street to listen to some Cajun music or whatever kind of music they play down here. But I like New Orleans. I'll see you guys. See you. Bye.
Good seeing you, Joey.